Hi everyone. So we are going to start the first lecture of this course, and in this we are going to talk about the commercial banks and macroeconomics. So we will try to understand what is the structure of the in Indian banking system and how it has evolved. So we will shed light on the evolution of the banking sector since independence, and we'll also try to cover some of the important aspects related to the banking sector developments that are important and one should understand. We'll also set up a context in the macroeconomic setup, and we'll try to see that how commercial banks, when they are put into a macroeconomic setup, then how it looks like and what is the complementarity, whether it is some kind of instability bringing kind of situation, or it is a direct positive relationship. So we'll look into all those dimensions, and I will also touch upon some of the recent developments that we saw in the case of the Indian banking sector, and how and what changes we made after those shocks. We will also touch upon some of the recent policy changes that we observed in case of the commercial banking in India, and we'll also try to touch upon some of the wider implications on the macroeconomy. So I hope this session will be fruitful, especially to those who are starting learning the commercial banking setup in India. In the case of Indian, that we'll also touch upon some of the important theories. Some of the theoretical aspects are required. So we'll also touch upon some of the theories related to commercial banking and macroeconomic setup, and we'll also touch upon some of their negatives and positives and how it has been designed. So let's start. So the course Introduction to Commercial Banking and Fintech, I wanted to give you a brief overview about some of the textbooks which are very much popular, not just in the case of India's economy, but also in the global context. So if you try to read about some of the books that we often refer to the Indian context, so one book which is very popular is the L.M. Bhole book by now it is with Mahakud of IIT Kharagpur. So it is called Financial Institutions and Market. This book is highly useful to those who are doing a bachelor's in economics or business or engineering, and those who want to get acquainted with the basic notions of the banking in India and how it works. Then the second, which is a recent contribution by Pathak has given a good account of Indian financial system. It is a very thick book, so both these books are very thick in terms of size, but I would say that it is worth buying it. It is affordable, not highly costly, but these books are some of the popular references that we see at college level and even at the university level undergrad courses. Then here we have, in global context, Frederick Mishkin book Economics of Money, Banking and Financial Markets is one of the important reference that we see. So this could be in the context of global context, you can see. These two books are in the Indian context. Right. So this is what we often try and find. Then if you want to read Principle of Macroeconomics by Rangarajan and Dholakia, so this you can also read. Some of the important papers like Mackinnon talked about the role of the banking. Then again, one more book by Mishkin, again it is Financial Market and Institutions. This book is also very much popular across, and if you want you can get into. The rest of the books are only for the references, but if you are interested, if you are Indian reader, then you can read this. If you want to understand in the context of global economy, then Mishkin book is a good reference, and rest of the books or papers are only for the reference purpose. So I hope this background has helped you understand that what is important. So let's think about the Indian banking journey from 1947 till 1991. So remember, when India got independence, we had around 5,000 banks in India operating at that time, and most of these banks were highly unregulated and mostly skewed. Some of them were having a very low capital, So efficiency was the major concern. Second thing is that most of these banks were owned by business houses, so their primary interest was to support their business as compared to the social goal. So we started with the nationalization. So first thing was that RBI, we nationalized in 1949, and we made an act, RBI Act, which later became the Banking Regulation Act. And at that time, since the banking sector were large, but these banking sectors, one of the limitations that I highlighted was the inefficiency, but also the concentration. So majority of these banks were concentrated in urban areas, and as I told that majority of these banks were owned by the business houses, so their focus was on the industry, or I would say the core business, as compared to social goals. So as a result, the rural segment was completely neglected. Then Government of India took a measure, and then it went for nationalization. So 14 banks were nationalized in 1969, then we did in 6 in 1980. So total 20 public sector banks came in. And then if you see the journey, so in the beginning, why government had gone for nationalization? So in order to meet the social goal, to serve the rural population, and also to underprivileged classes, and also the credit availability for the social objectives, education, health, and other purposes. So when India started with the nationalized banks, so what they did was that they increased the statutory liquidity ratio and the cash reserve ratio. So till 1970s, the cash reserve ratio was the policy rate. So now we see repo rate, but at that time it was cash reserve. So in the beginning it was bank rate, then later it was cash reserve ratio. So these ratios were very high. So it was like some kind of financial repression, wherein the banks were told to keep extra amount of money as reserve. So if you are depositing 100 rupees, then banks were told to keep at least 60 rupees in the form of cash reserve ratio, which is I will come back to this later, cash reserve ratio, or even the statutory liquidity ratio. So it is called SLR. So these two are ratios which banks have to maintain. On cash reserve ratio, banks have to keep certain proportion of the deposit that they receive from customer in the form of cash, and SLR can be in the form of gold, bonds, anything, right? So the percentage was kept high so that government can utilize this money for investment purposes. And this continued, but the end effect was the credit creation was weak, and this created a lot of trouble later for the banking sector. And most of these banks or lead bank scheme came in, wherein the nodal bank will be given the in the form of local bank, will be empowered to take or cater the rural areas, rural pockets, and even the semi-urban areas. So those were the case. At that time, the priority sector lending in this, the agriculture, small medium enterprises, you can see businesses were given preference, the public sector units were given preference, and as a result we saw that the output increased, and regional rural banks also played a very important role. And RRB was set up especially to cater the need of agriculture credit services, and it was established in 1975. So we saw that the first phase, which started with the private sector dominated banking system in 1947 and post, with which were around 5,000 banks, but then we nationalized banks. So first we did 14 banks nationalized in 1969, then 6 in 1980, and certain priorities were evolved by keeping the ratios high. So this was the case. Then in Narsimham committee, after when we had the balance of payment crisis, after that it was felt that the banking sector liberalization must be there, because economists started talking. So Mackinnon and Shaw, all those theories came in, and at that time it was felt that there is a need to expand the banking sector or open the banking sector. So Narsimham committee, first it was set up in 1991, then again in 1998. So Narsimham committee is responsible for the current banking structure that we see. With that, we opened also for the private banks. We also allowed liberalization of the cash reserve ratios or the SLR. So we did that. We also introduced the repo rate and other measures, so liquidity adjustment facility. So this created a whole lot of gigantic reform in the banking sector, and we also allowed the private sector banks, so HDFC, ICCI, Axis banks, and also the foreign banks were also allowed to operate. Then we also introduced the technology, so we see the ATMs, the core banking, and also the universal banking also started, which means that at one place you will have all the details. So net banking and all those things are the part of it. So later we saw that the net banking culture started, wherein you can access the banking services through your mobile. Now, post 2014, we saw that when we had the new type of the structure coming in, so in that we had gone for financial inclusion. So financial inclusion, the first step was to incorporate the large masses into a formal banking system. So what we did was we created Jan Dhan Yojana. Under that, around 500 million new accounts were created. It came with the fillers that you don't have to keep any money, it will be a zero balance open account, and with this we saw that whole lot of population came under the formal banking system setup. And then in 2016 we saw a major upheavals in the Indian banking system that led to the, you can say, uh, uh, major reforms in the banking system. So we saw, I think I'll be also discussing that in later, that we had a twin balance sheet crisis, and twin balance sheet crisis led to the overall development in the banking setup, and majority of the banks were having losses because RBI conducted asset quality review in the late 2015, and by 2016 we saw some of the banks were declaring high NPAs, and as a result the financial market also absorbed a big shock, and this led to the overall, I would say, creation of the bad banking in the Indian system. And to overcome that, we introduced the insolvency and bankruptcy code, which was later amended also. But IBC gave a way for tackling the high NPAs with the forms, and this is also one of the reasons. Then we saw recent developments like a small finance bank. So app-based borrowing and lending we allowed to some extent with some limits, and small finance banks for households and other needs for rural urban segments we saw, especially in our urban segment it became popular. Payment banks also became some kind of a new setup in the banking sector, where the smaller amount up to 2 lakhs deposit were allowed by the RBI to these banks, and they were also told to facilitate credit. So overall, the fintech evolution led to the payment banks, small form banks, UPI, Unified Payment Interface creations. Overall, digital banking revolution we saw in India, and it has been growing. And over a period of time, it is expected that it will grow cheap and bound. So here we have the new directions. So new directions, we see that there is a need for a digital currency which the RBI is contemplating, and also the banking sector and fintech collaborations. So for example, in India we see that the existing banking system has also grown like or it has also adopted some of the features of the fintech, and as a result we see high complementarity between the fintech startups and the banking. And we also find that both these startups are ecosystems are helping each other, so it is also important to highlight in that respect, right? And then here we have the, then we also saw that post 2006-7 we saw that stronger prudential norms were evolved globally. So after global financial crisis in India also we experienced that, and we found that the stronger prudential regulations were adopted. Even RBI has gone for coming up a 6 monthly financial stability report. So, and there is also the financial stability supervisory board. So this is also or financial stability development council, so it is also called FSDC. So those the structures are in place. The high NPAs in the banking sector has also led to some kind of systemic component of the banking structure. So that is also a new thing for the RBI, which RBI has come up with some of the newer regulations. The Basel norms are already in place, so it is also creating a big push. Then here we have a new development which is in the form of ESG and green finance. So ESG and green finance is something which we find that in the case of the as we are seeing that the climate change is becoming a major challenge for the global economy. So so CO2 emission and all other parameters need to be checked. So there are certain standards for the firm level carbon disclosures or environment social governance. So ESG that you are seeing. So E is for environment, then S is for social, and G is for governance, right? So environment, social and governance, ESG, has started playing important role, and we are seeing that there are a whole lot of factors coming in, and they are enjoying a new type of data which we are seeing, and there are a lot of studies talking about ESG domain. So environment, social, under environment, the companies have to disclose all the details about the carbon emissions, whether it is water, whether it is coal, what kind of fossil fuel are you using. In social, they look for labor rights and what kind of incentives are given to the laborers. Governance, they look at the board structure, and also there is a high correlation between the climate change mitigation and adaptation strategies adopted by firms, and also they are seeking loans from the bank. So there is a high interdependence. So ESG and green finance have become, and in green finance you can count for green bonds. Some companies issue green bonds keeping in mind the green initiatives, and they are supposed to use only for that purpose. So those evolving contours are also becoming part of the banking structure in India. So materiality related issues are also gaining attention. If you see the types of banks in India, so the very first is the commercial banks. So under commercial banks we include both scheduled and non-scheduled. Schedule, which is part of the second schedule of the Banking Act, and under that they are allowed to borrow, lend, issue whatever banking facilities they can introduce. Non-commercial banks are those which are not part of the second schedule, but still they are allowed to operate with certain. But second schedule is completely having well mapped regulations, so it is much easier for the central bank to regulate. Core operations of commercial banks is the credit creation. They receive deposit and facilitate the credit to the needy entity. So that is what payments. Whenever they are supposed to, so whosoever depositing money, whenever they want to withdraw, a bank is supposed to make the payment. Working capital finance. A lot of time, the smaller current account finances are provided by banks to the firms to maintain their daily liquidity. So it is also one of the important thing. Overdrafting is one where they provide the overdrafting facility, that if they have something, some amount kept with the bank, then they can issue more than what is kept, and then the banks will be adjusting those amounts later. Cooperative banks are those banks which are mostly related to the rural areas, and but you'll find in urban pockets also, where they cater the smaller segment, smaller households, farmers and all, and it is supported by the NABARD, which is the central bank of the agriculture sector in India. Then we have very specialized bank for lending, which is the long term financing. So IFCI, SIDBI, NHB, National Housing Board. So the idea is that such infrastructure development requires very concentrated financing. So for that we have a special vehicle which is development banks, and there are something called development financing banks which include the different types of financing, which is not just the long term, but it could be also equity or any other. Then we have the central bank in India. Reserve Bank of India is the apex authority, and the main job is to maintain the money supply in the economy, create enough money supply or the resources in the economy. Regulation of banks is also one of the important aspects of the banking sector, and they always try to provide services, and They always monitor the services of the banking, whether it is complying with norms or not. Then their objective is price stability, which they do it through monetary policy. Then here we have the financial stability. Financial stability is related to the how the prudential norms are designed, and in case of any shock that comes to the banking sector, how financial stability issue can be tackled. There are specialized banks also in India, which are of Exim Bank, you can say, to support the trade or export import financing, and it gives the credit to the needy agencies. There are payment banks, as I mentioned, so small deposits, remittances, people, Indian diaspora living in Gulf or any other country, they send money. So those, even the payments they cater. A small finance bank is mostly for micro and small enterprises, and also for the household, which is the recent development. So this is all about this. Now coming to why commercial banks and why do we need commercial banking. So commercial banks mobilize resources in developing economy. So this is where they connect savers and borrowers. So you can see that when borrowers and lenders are meeting, they always talk about this. Their role is vital where capital markets are underdeveloped. So this is also very important, especially in case of developing countries where the stock market is not well developed. So the financing needs almost 80% is met by the banks, and these banks as a result play a critical role in the overall development of the economy. So this is very important. Core functions of commercial banks. So if you see, the first is the savings mobilization, that they do it. Credit creation, which means that if you're depositing some amount, 100 rupees with the bank will keep, after meeting the regulatory or compliance requirement of reserves and statutory, they will be extending rest of the amount as a loan, and those loans come under collateral or uncollateral, but the interest earned on those loans are the major income. So if you think from the asset and liabilities point of view for the bank, this I will be discussing when we'll be discussing the balance sheet. So from the asset side, it is the loan, so interest on loan, you can say interest on loan. Liability side, it is the deposits. So deposits that you make in the bank, for bank it is liability, because bank is supposed to pay rate of interest on that. So they have to make sure that they get this money from somewhere. Payment services, checks, cards, NEFT, national, you can say electronic funds transfer, then RTGS, right? Remote whatever transaction guarantee services that here we have. A unified payment interface, UPI, that we see, QR code based transactions. Then they also try to convert the short deposits into long loans, which means that if they have a pool of short deposits, then they can easily use that for making a long term loans, and whatever interest that they are getting, they will be able to make the redemption request, and as a result, the difference, the spread that you have, how much money you are paying for the short deposit redemption and how much you are making from the loan, that spread is the income of the bank. So these things are important. Then coming to the financial development. So financial development and economic growth is one topic that we often discuss. So financial development and economic growth. So this one topic that we often discuss, and majority of the economists agree, or sometimes they do not agree with this idea. Sometimes they say that economic growth propels financial development. Sometimes they say that financial development propels the economic growth. So this is where the challenge comes in. Sorry. But if you think about the major role of banks in financial development, so the very first thing comes in mind is the efficient allocation, the fund infrastructure SMEs, inclusion, the financial inclusion, which means that they have to cater to the underserved population, right? The innovation that you drive, so drive digital payments and all. So Schumpeter long back mentioned that the financial institutions are the Mecca of innovation, because they facilitate innovation through financing, and majority of the entrepreneurs, bet on new innovations because of the bank guarantee. So this is where, so monetary transmission, so whenever the central bank changes the rate of interest, how it impacts the overall the spread of credit to the overall economy. So those angles are looked at monetary transmission. We'll be talking in detail about monetary transmission in the later lectures, and I hope it will be very, very useful. Mackinnon and Shaw in 1973 they highlighted this. If you think about the capital formation, so what is the first step? First step is the household saving. So people are earning in wages, and then they are using some amount in wages for consumption and some amount they are saving. This saving that they are doing, they are keeping in the bank is giving rate of interest. So whatever money that goes to the bank is using further for lending, and if that lending turns into investment, then saving investment channel plays a very important role. So Goldsmith defined this in 1969. Then infrastructure, we know, employment, we know that how SMEs play important role. External linkage, export import bank, we saw that how it helps. Sometimes they also nowadays in global after globalization, we saw that the banking system, banking services were extended till the settlement of the transactions happening in the stock market. So capital inflows, outflows are also regulated through the banking system. So this is where it is important. If you think in terms of theoretical and empirical dimension, so maybe I will touch upon this in the next session. So I hope this background has helped you understand the overall structure of the banking system and how in India we have evolved, what is the role of the banking sector. And with this lecture, I'm sure you will be having the deeper understanding that why when we talk about a bank, why that bank is very important and how it liquidates the economy in a bigger way, and through the credit creation, through infrastructure development, through promotion, through financial development. So it has the overall role, especially in developing country like India. Banking is still playing important role. More than 50% of the credit goes through the banking sector, and also the stock market and other segments are important for long-term borrowing and lending, but banks are still important from that perspective. So I am stopping it here. Thank you so much for your attention. I appreciate.